You're standing in downtown Chicago, the skyline stretching ahead and the city buzzing with energy. But beneath the surface, a shift is happening in the real estate market. So, here's the real question. Is Chicago's 2026 market a gold mine, or is it slipping away? The truth is, Chicago in 2026 is a smart money market, but you need the right strategy to succeed. Let's dive into what's really happening in the market and what it means for you as an investor. What's happening in Chicago real estate in 2026? Before we dive into strategies, let's take a step back and get a clear picture of what the numbers are telling us. This is what you need to know about Chicago's current real estate landscape. Prices are rising, but slowly. Chicago's average home price is around $312,457, showing a steady increase of 2.5% year over year. Homes are now going under contract in about 26 days on average. While that's not the skyrocket growth we see in some coastal cities, it's a sign of stability, and stability in real estate is a good thing for investors. Slow and steady is often exactly what you need to build long-term wealth. Inventory is loosening just a little. For years, Chicago's real estate market was tight, a classic seller's market with low supply. But in 2026, that's finally starting to change. Homeowners are beginning to list more properties driven by the need to take advantage of ultra-low mortgage rates. It's not a huge shift, but it's enough to make room for savvy investors looking to grab opportunities. Rent growth remains strong. The rental market in Chicago is holding strong. Multifamily rent growth has been steady, hovering around 4.6%, with projections showing it will grow by 3% in 2026. If you're thinking long-term, this is a solid signal that investing in rental properties is still a smart move. Multifamily supply is tight. Chicago has one of the lowest growth rates for new rental units in major metro areas. This means fewer new properties are hitting the market, which gives landlords a competitive edge. The tighter the supply and the steady the demand, the higher the rental prices will go. Exactly what you want as an investor. Sales have room to grow. Experts are projecting 5% growth in sales for 2026, thanks to a decrease in mortgage rates. More buyers are entering the market, which suggests Chicago still has room to grow. This is a strong indicator that now is a great time to get in if you've been waiting for the right moment. Mortgage rates are easing. Mortgage rates have been trending downward, sitting around 6% compared to the 7% range last year. This drop in rates is reigniting buyer interest and improving affordability, making it easier for investors to secure financing. What does this all mean for you, the investor? Chicago in 2026 is not a get-rich-quick market. It's not about rushing in and hoping to catch a lucky break. What this market offers is a chance to build long-term wealth through careful, strategic moves. Chicago is not a casino, it's a chessboard. If you make the right moves, you stand to earn significant rewards. So, let's talk about the best strategies you can use to succeed in this market. Top 7 real estate investment strategies for Chicago in 2026. Number 1. Multifamily buy and hold, your foundation strategy. The multifamily buy and hold strategy remains a solid investment in Chicago's market. Why? Rent growth continues to outperform the national averages, and vacancy rates remain low. Plus, with new supply being limited, particularly in high-demand areas like downtown and nearby suburbs, multifamily properties are in strong demand. Unlike flipping, which requires timing the market just right, buy and hold lets you enjoy consistent rental income while benefiting from long-term appreciation. This is the tried and true foundation of many successful real estate portfolios. Pro tip: look for Class B assets, which are slightly older properties in well-established neighborhoods. These buildings are often priced lower but still offer great rental yields and have lower turnover than high-end condos. Number 2. House hacking. House hacking is an investment strategy that's particularly popular among younger investors. Here's how it works. You buy a multi-unit property, like a duplex, triplex, or fourplex, live in one unit, and rent out the others. The rental income you generate helps cover your mortgage, meaning you can build equity without the burden of a huge monthly payment. Why is it so effective? Well, in Chicago, 40% of rental housing supply is made up of live-in landlords. It's a smart, affordable way to get started in real estate without being buried under a massive mortgage. It also allows you to pay down debt while building your wealth. Power move. Use the rental income to pay off your debt and then reinvest the profits into growing your portfolio. It's a grind, but it's a much smarter long-term play than paying rent. Number 3. Neighborhood stacking. Chicago is a city of micromarkets, with each neighborhood offering different investment opportunities. Some are booming, while others are still ripe for growth. In 2026, West Loop leads the charge with its proximity to the tech scene and high demand. Lincoln Park offers long-term stability thanks to great schools and parks. Lakeview combines space with convenience, making it highly desirable. Wicker Park and Bucktown attract those seeking a bohemian lifestyle, and South Loop offers great potential for appreciation as downtown expands. All these neighborhoods are walkable, with top-notch schools and job opportunities, making them prime for steady rental demand. Number 4. Buy, rehab, rent, refinance, repeat. The buy, rehab, rent, refinance, repeat strategy is all about creating long-term wealth. Buy distressed properties, fix them up, and refinance once the value has gone up. This lets you pull out capital and reinvest it into your next project. Why is it so effective in Chicago? The market here is stable, and prices are not fluctuating wildly. Plus, with mortgage rates trending downward, refinancing is a great way to pull out cash to fund future investments. Unlike flipping, which can be more unpredictable, BRRRR is about scaling your portfolio over time. Number 5. Short-term rentals. As the world reopens, short-term rental demand in Chicago is surging. Think about properties near downtown, Lake Michigan, or the convention center. These are prime spots for short-term rentals like Airbnb. But, a word of caution, Chicago has strict short-term rental regulations, so make sure you're familiar with the rules before jumping in. If you get it right, the returns can be substantial, but it all depends on location and management. Number 6. Niche commercial investing. Chicago is seeing a rise in niche commercial investments. For instance, the demand for data centers is growing rapidly, with rents increasing by 11% in 2025. As technology advances and demand for cloud computing and AI skyrockets, commercial spaces like data centers, industrial parks, and mixed-use buildings are becoming attractive investment options. Commercial real estate isn't just for the big corporations anymore. There are opportunities for smaller investors to partner in syndications and funds focused on niche markets. Number 7. Land and new construction. With supply tight, land and new construction offer appealing opportunities in Chicago. Developers are targeting infill land and mid-density construction projects near transit hubs and employment centers. While land deals can be complex, the potential payoff is high, especially in areas near jobs and transit. If you found this video helpful and want more insights on how to succeed in Chicago's real estate market, make sure to hit that like button and subscribe for more. Stay ahead of the game and turn your investments into long-term success. See you in the next video.